Welcome to Value Vest Daily. Today, we are diving deep into one of the biggest market stories of 2026, the Dow Jones Industrial Average blasting past the 50,000 mark for the very first time. And look, this is way more than just a big, flashy number. It's a huge signal about a major shift happening just under the surface of the market, a change that could really impact your portfolio. Let's get right into it.
So here it is, 50,116. That was the final bell on February 6, 2026. Now, this wasn't some gentle crawl across the finish line. Oh no. This was a 1,207-point explosion in a single day. We're talking a 2.47% jump, the best day we've seen since May of last year. Just let that sink in for a second. An index of 30 of the biggest companies in America surging almost 2.5% in a matter of hours. So what on earth caused this sudden rocket fuel of optimism, and how did we get here? That's exactly what we're about to unpack.
All right, to really get our heads around this historic moment, we're going to break this whole thing down into 5 key parts. First, we'll paint the picture of the record-breaking day itself. Then, we'll pop the hood and look at the engine behind this surge. Third, and this one is huge, we'll explore this critical idea called the Great Rotation to Value. After that, we'll get practical with a playbook for you, the investor. And finally, we'll look ahead at what's coming next. So let's kick things off with the day it all went down.
Okay, so let's set the scene. You've got to understand this historic day didn't just happen in a vacuum. It actually came right after a pretty tense 3-day sell-off where investors were getting seriously jittery. The market was looking shaky, people were pulling their money out, but then, boom, Friday just completely flipped the script. That massive reversal from fear to euphoria really shows you just how fast things can turn on Wall Street. And it really begs the question, what was the spark that lit this fire?
Now, this chart tells a really fascinating story about 2026 so far. Just look at this split. The Dow, right there in orange, is up a solid 4.3% for the year. But then, look at the S&P 500 in the middle, barely up at all. And then you see the tech-heavy NASDAQ on the right. It's actually down. This isn't just random market noise, folks. This is a perfect picture of the main theme we're talking about today. The old-school industrial and financial giants in the Dow are taking the lead, while the tech darlings that have been ruling the roost for years are taking a breather. The big question we've got to answer is, why is this happening now?
And you know what? This wave of optimism wasn't just an American story. Not at all. On that very same day, Japan's Nikkei index surged an incredible 5%, and South Korea's Kospi was up 4%. Even Bitcoin was bouncing back. This shows a big global shift in attitude. Traders call this a risk-on pivot. It basically means investors all around the world collectively decided, okay, time to move our money out of safer stuff like bonds and get back into things with more growth potential like stocks. It was like a global green light for the market.
All right, that brings us right to our second section. It's time to look under the hood and really deconstruct the why behind this rally. This milestone wasn't just some random burst of good feeling. It was actually built on a foundation of some very specific economic and company signals that we're about to dig into, starting with the biggest tech story of our lifetime, artificial intelligence.
Okay, so a huge piece of this puzzle is the whole story around AI. At first, the market was actually really spooked. You had giants like Microsoft coming out and reporting these eye-watering capital expenditures. We're talking around $38 billion just to build out their AI gear. The immediate fear was, whoa, this massive spending is going to crush their profits. Investors were worried that this AI arms race was turning into a giant black hole for cash. But then, we got a completely different signal from the other side of the equation. TSMC, the Taiwanese company that makes the high-end chips for pretty much everyone, reported a stunning 35% jump in profits and announced their own massive spending plan of $56 billion for 2026. And that was it. That was the signal the market was waiting for. It confirmed that the demand for AI isn't just real, it's getting even bigger, and that shot of confidence just rippled through the entire system.
And it's not just tech. This whole rally is sitting on top of a surprisingly strong U.S. economy. This chart here shows you the main pillars. In the third quarter of 2025, GDP grew at a really healthy 4.4% annual rate. So what's powering that? Well, as you can see, it's a mix of strong consumer spending, that's you and me buying stuff, and serious business investment, which includes all that AI spending we just talked about. And the really important part is that this happened while the unemployment rate stayed super low at 4.4%, suggesting this kind of balanced low-hire, low-fire job market that isn't running too hot. The key thing here is that the economic foundation is solid, and that gives investors the confidence to keep buying.
And then, of course, there's the big one, the Fed. The market is always trying to guess what's next, and right now, it's betting big that the Federal Reserve will start cutting interest rates later this year.
With inflation finally showing signs of cooling off, investors are thinking the era of super high borrowing costs is almost over. This expectation acts like a major tailwind. Think of it like a powerful wind at the market's back, just pushing it forward. This is especially good news for those cyclical, value-type companies that make up the Dow, manufacturers, banks, because lower borrowing costs can seriously boost their profits and make their stocks look a lot more attractive.
So you add all that up, a solid economy, the expectation of lower interest rates, and some tough questions being asked about the real cost of tech growth. All of this leads us to maybe the most important part of this whole story, what a lot of people are calling the great rotation to value. This is a massive shift in where investors are choosing to park their money, moving away from those high-flying growth stocks and into something completely different.
This quote right here just nails it. For the last 5 years, AI-focused stocks were the absolute kings, outperforming the S&P 500 by an incredible 136%. I mean, they were priced for pure perfection. But now, like we saw with those CapEx concerns, they're under a microscope. Investors are shifting their focus. The question is changing from how fast can you grow to, yeah, but are you actually making any money? And that fundamental change is forcing them to look for opportunities somewhere else.
This table really lays it all out, nice and simple. On the left, you've got your growth and tech stocks. They trade at a high price-to-earnings, or PE ratio. Basically, a high PE means you're paying a lot for every dollar of profit because you expect huge growth down the road. Their biggest risk right now, that massive CapEx spending eating into their profits. Now look to the right. You have value stocks, like the industrial powerhouse Caterpillar. They trade at a much lower PE, maybe around 15. Their big risk is that they're sensitive to the wider economy. But in today's world, with a strong economy and expected Fed cuts, investors are suddenly falling in love with their strong, stable earnings and those reliable dividends. That right there is the great rotation in action.
Now, here's a quirky thing about the Dow you've got to know. Unlike most other indexes, the Dow is price-weighted. So think about it like this. In an index like the S&P 500, the biggest company by total value, like Apple, has the most sway. But in the Dow, it's the stock with the highest price per share that has the most influence, no matter how big the company is overall. So a $10 move in a high-priced stock like United Health has the exact same impact as a $10 move in a lower-priced stock. This little detail makes the Dow extra sensitive to what's happening in those key, often higher-priced value sectors like healthcare and finance.
Okay, so what in the world does this all mean for you as an investor? Let's pivot to our fourth section. The Investor's Playbook. This is the so what part of our explainer, where we turn all these big market moves into some potential strategies and things you can actually think about. So here's a potential 3-step game plan. First, think about diversification. For a lot of us, trying to pick individual winners in this kind of rotation can be really tough. An ETF, that's an exchange-traded fund, like DIA, which just tracks the Dow, gives you broad exposure to all 30 of its value-focused companies in one single trade. It's a simple way to get in on the trend without putting all your eggs in one basket. Second, and this is so important, focus on earnings quality. Hype is temporary, but in the long run, profits are what drive stock prices. You got to look past the buzzwords and dig into the numbers. Is the company making money consistently? Are its profit margins solid? That's what really matters. And third, be ready to act. We've got key data coming up that could shake things up. Don't panic when things get choppy. Instead, think about using any potential market dips as a chance to buy quality companies you believe in at a better price.
But of course, you've got to be smart about this. No strategy is complete without understanding the risks, and there are 3 big ones on the radar right now. First, keep a close watch on big tech earnings. Are those massive AI budgets starting to seriously hurt their bottom line? A few bad reports could sour the mood on tech all over again. Second, watch the upcoming economic data. If the jobs market comes in way hotter than expected, it could force the Fed to put those rate cuts on hold, and that would definitely be a headwind for the market. And finally, inflation is still the big one. If that next CPI report shows inflation is still sticky or, even worse, heating up again, it could easily trigger a big market-wide sell-off as fears of more rate hikes come roaring back. And that leads us perfectly into our final section. What to watch next. The market story is never over, right? And the very next chapter is going to be written by a couple of key economic reports that are just around the corner.
Okay, get your calendars out because these next few days are huge. On February 11th, we get the January jobs report. The forecast is for around 55,000 to 70,000 jobs added. Why does this matter? Well, a number that's way higher could suggest the economy is too hot, which would spook the market into thinking the Fed won't cut rates. A number in that range or lower could strengthen the story of a soft landing and keep those rate cut hopes alive.
Then, just 2 days later, on the 13th, we get the CPI report, our main measure of inflation. The market is desperate to see that number keep going down. Any surprise to the upside here would be a major problem for stocks. These two reports are going to set the tone for the market for weeks.
So when you put it all together, what's the big takeaway? It's pretty clear. The Dow's historic push past 50,000 isn't just random hype. It really seems to be a logical rebound based on real economic strength and the significant rotation towards value stocks. But with that key data just ahead, things could get choppy. For investors, discipline and having a clear strategy are absolutely crucial right now.
You know, this whole shift towards value has a lot of people reevaluating their watch lists and asking all sorts of new questions. For instance, a common one we're seeing pop up is about companies like Hims, the digital health company. Is a company like that, which kind of sits between tech and healthcare, a buy now in this new environment? We'll save that deep dive for another explainer, but it just goes to show you the kind of thinking investors are doing now, looking for value beyond just the obvious big tech names.
All right, before we wrap up, just the standard but very important disclaimer. All the content we provide here is for educational and informational purposes only. It is not financial or tax advice, and you should always talk to a qualified professional about your own personal situation.
So there you have it, an incredible milestone for the market. If you found this breakdown helpful, please subscribe, like, and share ValueVest Daily for daily learning opportunities before you put your money to work. And one more thing. Please put in a comment if you want us to deep dive into any specific high-risk/reward opportunities. Thanks for tuning in.